management and accounting techniques. Now, today we have with us, or rather, I would proudly present to all of you today's resource person, my Professor Chanchal Chatterjee, who happened to be my colleague, then became my friend, and now he is like my younger brother. So we started our career together at St. Xavier's College, Kolkata, way back in 2006-7, and now we have moved to our own areas, but we are still connected, and I am so proud to present in front of you Professor Chanchal Chatterjee of International Management Institute, that is IMI Kolkata. Now, a brief introduction of Professor Chatterjee. Professor Chanchal Chatterjee is a professor of finance at IMI Kolkata. He did his graduation and post-graduation in commerce from the University of Burdwan, West Bengal, that is from our university, the host university, and stood first in first class at both the levels, thus having the rarest of the rare achievement of being a double gold medalist at university level. He earned his PhD from the same university on the topic financial restructuring through buyback of shares, in relation to which he obtained the best research award in finance track in the third doctoral colloquium of the prestigious Indian Institute of Management, Ahmedabad, in the year 2010. He also completed his postgraduate diploma in business administration in finance specialization from Symbiosis, Pune. Professor Chatterjee has been a prolific researcher over the years and has published several research papers in refereed national and international journals. He has also presented papers in seminars and conferences across the globe. His areas of research interest include corporate finance, corporate governance, earnings management, and corporate payout policy. And I would like to further state that Professor Chatterjee is the proud recipient of Saurabh Shirvare Memorial Young Researcher Award in the year 2016, which has been awarded to him by Indian Commerce Association for his outstanding contribution and achievement in the discipline and profession of commerce and business management. So with these few words, I have many more things to say. I welcome my friend, Professor Chanchal Chatterjee. Chanchal, the session is yours.
Thank you, Vic. Thank you very much.
Yeah.
For your kind introduction. Although you have introduced me nicely, but I am just one of all of you. Now we will start the session. I am not very much well acquainted with Google, this Google Classroom. Rather, I am more acquainted with Zoom platform. But anyways, let us start our discussion. First of all,
if you want to share the PowerPoint, then you can just go with this button, the share.
Yeah, that much I can manage. If I need help, I'll definitely seek your help.
Sure. Our support team is there to help.
Sure. Thank you. So, first of all, good morning to all of you. Before we start the session, let me give you a very brief aspect of what we are going to discuss today. Please don't consider me as an expert. I am just one of you. We would like to discuss about certain aspects in the field of corporate finance mostly. Mutual discussion. Feel free to ask any questions so that we can learn from each other. So initially I had a plan to talk, if you see your brochure, you will find that I had a plan to talk about enterprise value and capital structure. But later on, I realized that most of the participants, they are already PhDs, they are teaching in different colleges and universities, research scholars are also there. So merely talking about some aspect from teaching perspective may not be that much interesting to us. So it's better if we talk about a particular research area and we try to understand certain aspects in that research perspective. So what I'm going to discuss today is from a research perspective, not about the capital structure or enterprise value. Rather, we will talk about one broad research aspect, that is earnings management and corporate governance. Okay, that's the main focus. In next two sessions, we will discuss this part. Now, while discussing this part, I'll take the reference of one particular research design. One is published, other is unpublished. But while we are discussing this, it's not that I am talking about only that paper. I'll also try to discuss about some other aspects, various other aspects which are important while we are trying to publish any paper. So in that line, I would like to start my discussion. And during this discussion, please feel free to stop me at any point of time, ask questions, so that we can rather develop a good understanding about this perspective. Now, when you talk about this earnings management and corporate governance, as since I'm a management faculty, there are different. I guess there are different faculties, research scholars, who have specialization or orientation towards different subjects, different areas, maybe marketing, maybe finance, maybe OBHR, maybe strategy, whatever. So the topic which I am discussing is earnings management and corporate governance. Not that everyone will be working on that area or you are working on that area. No, maybe you will be working on some other areas also. But important thing is that since this FDP is mostly in the field of accounting and finance, so I can presume that most of you are more or less oriented towards finance and accounting research. Okay, so
Professor
in that
Chatterjee,
context,
I would like to
yes,
just interfere once and confirm to you that
sure.
all the participants are from finance and accounting
Fine. Okay,
specialization.
okay, okay. Initially,
So,
okay. I
yeah.
was thinking maybe management areas also.
No, because this topic is on finance and management
Fine.
specialization. So
Okay.
intentionally, when I approved only for finance faculty members only and finance research scholars.
Fine, fine. So that will be more focused group of discussion. That's fine. So in the field of, since most of you are doing in the field of finance, but let me also talk about that. If you are from any B school or management institutes, you may find that this cross area or interdisciplinary research has become also very much popular. So not necessary that the topic which we will be discussing will be completely restricted to finance area. You can always there can be a close association in the area of strategy also, mostly finance and strategy. So with this, let me start the discussion. Give me a minute, please. Well, when I'm sharing this screen, yeah.
Yeah, it is getting reflected.
uh, is it coming?
Yeah, it is getting reflected slowly but steadily.
Okay, okay. I'm waiting.
Not yet.
Not yet. Just a minute. Just a minute.
Yeah.
Is it visible now?
Yeah, now it is full screen and clearly visible.
Okay, fine. So let us start about the discussion. That I'll be dividing my discussion into two parts. One is your the first part, that ownership pattern, corporate governance, and the earnings management part, and the second one is related to disclosure or readability of financial statements, that we will discuss in the second part. Now, first of all, in case of earnings management, let us start the discussion. Now, if some of you are already working in the field, in this earnings management field, you are well acquainted. Some of you may find it new. So let me give a brief introduction about what's called earnings management. Now, for corporate world, reporting of earnings is very important. And based on that earnings reporting, investors take some crucial decisions. But sometimes we find that the earnings which are disclosed by the corporates, not necessarily those are the true earnings or actual earnings. There may be some doubt in certain cases that whether those earnings are actually managed properly or camouflaged, or rather you can say manipulated or not. Now, in this context, the question comes earnings management. Earnings management is actually, if you see the fundamental aspects of earnings management, occurs when managers, they're using their own discretion to either inflate earnings or to reduce the earnings according to the situation, according to the requirements. So sometimes they may inflate earnings, sometimes they may reduce earnings, depending upon different circumstances. So uh, means when managers, they try to manage earnings, they try to hide something and report something different, that is called earnings management. Now, broadly in the literature, there are two types of earnings management. One is called real activity based earnings management, and second is called accrual based earnings management. Real activity means when managers, they are actually changing the timing or the structure of the maybe operating decision, investing decision, financing decision. We call them real earnings management. For instance, if you reduce your R&D expenditure, your earnings may go up. So that can be one way of real earnings management. But the earnings management, which is very much rather got more focus, is called accrual based earnings management. When managers, they try to apply their own discretion while preparing the financial statements, and what they want, they by changing the by applying their discretion, they try to manage earnings. For instance, you change the method of depreciation, you'll be getting one kind of earnings, different types of earnings, or you change the provision for doubtful debts, or you can go for overestimating or underestimating the doubtful debts. Automatically your earnings will be changed. So one is real earnings management and second is accrual based earnings management. The main fact which we will discuss in this session is accrual based earnings management. Okay, that is more prevalently, more widely practiced. Now, if you talk about the real earnings management, if you talk about this real this earnings management part, real and accruals, question comes: why do managers try to manage earnings? What are the reasons? What are the reasons? There can be multiple reasons. I am just trying to highlight some of the important reasons. See, analysts have their expectations, investors have their expectations about the earnings of a company, and managers have the pressure to meet those expectations. Okay, so if you cannot meet those analyst expectations, generally there can be some negative impact on the managers. So mostly, in order to meet those expectations, managers may, I am saying may, they may go for earnings management. So if you see that Mulford and Comiskey 2005, this paper, they found three important motives. One is maintaining a smooth and sustainable earning stream, that you are showing, yes, I am maintaining a sustainable earning stream. You are meeting the prediction of the analysts, and also sometimes achieving managers' personal goals, because managers' personal goals are very important in this case. Now, managers' personal goals means if your earnings come down, your perks, the perquisites or the benefits which managers are receiving, that may be cut, that may be reduced, or the promotion or the other advantages which managers are likely to get, that may be reduced. So because of their personal benefits also, sometimes managers may go for earnings management. Okay. Now in this case, when we talk about this earnings management, there is a question of information asymmetry, that what is the actual earnings and what is the earnings reported by in the financial statements. So be it personal reasons of the managers, personal goals, be it maintaining the or meeting the expectations of the shareholders and analysts, always managers may go for earnings management. Now, if you talk about this earnings management part, uh, if you look at the literature, okay, literature part, I not talk much about this, because you can always, if you are working in that field or you will be working in the field, there are ample literatures in this field of earnings management. Only certain important points I would like to mention. So these literatures that I have just pointed out, mostly they talk about those things. Either managers manage earnings to to ensure their personal benefits, sometimes meeting expectations of the shareholders, meeting expectations of the analysts, etc., etc. Now, if you talk about this earnings management part, you will feel that in case of earnings management, cash handling is very important part, cash holding. So how much a company is holding cash, and what the company is doing with that cash, that's a crucial part. Now this cash holding part I will not discuss right now. In the second part, I'll talk about the cash holdings part in more detail, in a more detail. Now, if you see this literature, you'll find certain important theories in the field of earnings management. One of the important theories, obviously, the free cash flow theory. And in case of free cash flow theory, as we know, that when managers have excess free cash flow, okay, so what they are going to do with this excess free cash flow, that plays an important role or important aspect. Now, on the other hand, if the actual cash position is poor than what is reflected, then also there may be some question of cash misappropriation or other problems. So free cash flow theory is very crucial in the field of earnings management, which was first pointed out by Jensen in 1986. I'll talk about free cash flow and cash holding part later on. Now, if you see the Dietmar paper in 2000, Dietmar et al. 2003, they also find that firms that hold more cash in countries with greater agency problems. Now, this part again, I am not discussing in this case. I'll talk about this cash flow part in the next part. But the basic thing is that if you are holding more and more cash flow, more and more free cash flow, there are chances of earnings management. Okay. Now, if you talk about the next part, these are the certain first few things that we have mentioned. It's about the why managers manage earnings. Now, the second part, that is the main focus of this study, we are trying to find out a linkage that if a company has good governance system, good corporate governance system, does it help in reducing earnings management? Means, can we assume that companies which have a good, rather sound corporate governance system, does it really help in reducing earnings management? That is the main focus. So here I have highlighted certain important studies, Beasley, Pharma and Jensen. Those are noted studies in this field. Okay, and they talked about that whether good corporate governance or corporate governance variables, whether they actually influence earnings management or not. Okay, means if you have a good governance system, can you assume that earnings management will not be there? Or can you assume that quality of earnings reporting will be better? That's the main research question. Now, in this case, if you talk about the good corporate governance system, some of the aspects that we can see. Now, here, when you are writing any paper, this is the first part that I would like to mention, that the topic which you are selecting, suppose in this case, we are talking about the ownership pattern, corporate governance, and earnings management. Now, in this context, in your writing part, what actually you are trying to contribute, what is your research question, that should be reflected in the introduction section. Sometimes when reviewers see your papers, they make their initial decision whether to go ahead with the review or they will try to reject. If you consider a good quality journal, they first want to understand what is the main research question you are trying to address in the introduction part only. So what research question you are addressing and what is your contribution, that has to be highlighted in the very first or second paragraph of the introduction. So that part is very crucial. We should keep in mind. Now, for instance, in this paper, I am talking about the linkage between board composition and earnings management. Now, the question is, if you see that board composition means corporate governance, variables, and earnings management, there are multiple papers, hundreds of papers throughout the world. And obviously less, but still there are a large number of papers in the emerging economies context like India. So question is, what is the new in your paper? So why should the journal consider your paper? So in that case, whenever you are taking any existing topic on which already some papers have been published, still you want to work on that, you have to highlight that what is the distinguishing feature or what is the special contribution of your study. That has to be established very nicely in a very brief manner in the introduction part. For instance, in this paper, if you see the study period, I will discuss this later on in this session only, that I have tried to address the earnings management part after implementing the new Companies Act 2013. Okay, so this earnings management, whether companies are managing earnings or not, that is reflected after implementing a new Companies Act 2013. So that it becomes a distinguishing feature. And also with the new corporate governance norms. So those who are already studying or working in the field of corporate governance, you are much aware of the fact that SEBI constituted different committees from time to time. The recent being the Uday Kotak Committee that was set up in 2017, 2018, they submitted the report. So when the new committee was formed and this committee is giving some recommendations, based on the recommendations of that committee, we would like to consider the policy aspects of corporate governance and earnings management. And third distinguishing feature is that already we know that after implementation of Companies Act, India has also implemented IFRS system. We call it Ind AS. So IFRS system phase wise it's implemented. So all the listed companies, public companies, they have implemented by 2016-17. That was the last date. Okay. So in the field of New Companies Act, in the context of Uday Kotak Committee, and in the light of new accounting system. So if you see the IFRS system, new accounting system, the reporting of equity, the reporting of debts have been changed from the previous system. So when the accounting structure has undergone a change, under this accounting, under the new accounting structure, how you are designing your study, that is a distinguishing feature. Now, whether reviewers will be convinced with my logic or not, that's a different issue. But you have to highlight this at the very, very beginning part, means introduction part. Okay. I am not receiving any kind of response from you. So please feel free if you have any query. Okay. It should not be one-sided. Just I'm speaking and you are listening. It's not like this. It should not be one-sided. This is the first part that you should highlight in your introduction part. Second is either in the introduction part or in the LR part, literature review part, make sure that the study which you are conducting on should have the reference to the theories. If it is existing theory, or you are addressing any theory, or you are proposing any new theory, that has to be reflected in the introduction and LR part. That in the context of literature, in the context of existing theories, what are the theories you are trying to address? Because ultimately, whatever studies we are doing, those will be linked to any existing theories, or maybe you are proposing some new innovative theory. So linkage with the theoretical background is a very, very important part. And if you as far as my limited experience is concerned, you can see 80 to 85% of the papers are initially rejected because those are not linked with any kind of theories behind that. So whatever data you are taking, whatever analysis you are making, whatever methodology you are using, ultimately this has to have a linkage with the theory. So theory development is the main focus of the research. So if that is missing, so whatever be your methodology, whatever be your data, whatever be your other aspects, findings, the paper is not going to be accepted in a good journal. So please keep that fine and keep that in mind, that linking with the theories is very important. So, for instance, in this case, if you talk about earnings management and corporate governance, there can be three important theories. One is the agency theory. So Jensen agency theory, the agency conflict between the managers and the shareholders, that has to be reflected. Free cash flow theory, whenever you are holding extra free cash flow, what are you doing with that cash flow? Are you returning to the shareholders in the form of dividend, or you are keeping in the business for better investment, or whether you are managing earnings or not, you have shortage of cash or excess cash flow or not. So free cash flow theory. And the third part is management obfuscation theory. Management obfuscation theory, some of you may not be familiar with this. I'll discuss in the next part. But to be brief is that obfuscation means sometimes managers in their financial reports, they try to hide the bad things and they try to highlight the good things. It's human psychology generally. It's easier for a human being to say I am good, but it's very difficult to say I am bad. So when companies are not doing well in any financial parameters, so when they try to hide something wrong, and they try to bifurcate this part and showing something different, this is related to management obfuscation theory. We will further discuss this part in the next session. So these theories, be it agency theory, be it free cash flow theory, be it management obfuscation theory, or you are proposing some new theories, please note that those theories should be reflected in your introduction part, as well as introduction part or LR part, in a nice manner. So closely knit, this part is very important. Now, next part, which we'll talk about, the objectives of the study. Here I am talking about mostly the linkage or the relationship between earnings management, the ownership pattern of the companies, and the board composition, means the corporate governance parameters of Indian companies, listed Indian companies. And this framework is nothing new, but this framework I want to test in the context of three new aspects. One is New Companies Act 2013. Second is the new corporate governance norms and the recommendations given by the Uday Kota Committee in 2017, and in the context of new accounting standards IFRS or Ind AS in the Indian context. Okay, so that's the main objective of this study. If you see the data part, initially, just it's not that you are doing the same research, but just since I am trying to discuss in the context of a specific research paper, that's why I am giving all these things. So when you design your research, the data part is that initially we took 500 listed firms listed in NSE. Now, if you want to do in the context of earnings management, you exclude the government-owned firms and financial firms. Now, whenever you are selecting the final, designing the final sample, here there are certain aspects you need to be very specific about. Suppose if you see my initial sample is 500 and my final sample is 364 non-financial firms during the 3-year period, 2017 to 19. Now the question is, if you just directly mentioned we have taken 364 non-financial firms, that is not justified. You have to understand, you have to reflect very clearly how we have arrived at 364 non-financial listed firms. So initial 500 firms listed in NSE, it's NSE 500. Then you have excluded government-owned and financial firms. Why you have excluded government and financial firms? That's a very crucial part. So you have to mention in your data selection part that what is the reason behind the exclusion of those kind of firms. Financial firms, because banking, insurance, these are highly regulated industries. The scope of earnings management is very completely limited, because those are closely monitored by RBI, and their accounting disclosure patterns, accounting framework is also different. That's why we have excluded financial firms. Why have we excluded government-owned firms? Because government-owned firms do not have any incentive to manipulate earnings. For instance, the perquisites, benefits, other advantages of the top management team. If earnings are increasing, they'll be rewarded. If earnings are not increasing, they are declining, they may lose their job, they may be punished. But that is not the case in case of government-owned companies. So truly speaking, the managers of government-owned companies do not have much freedom, do not have much incentive to manipulate earnings, to manage earnings. There is no such incentive. So we have excluded government-owned companies. Then we have excluded the companies for which you don't get either accounting data or corporate governance reports. And after this exclusion procedure, finally you are getting 364 for non-financial firms for 3 financial years. Now 3 years, 364 firms, counting to 1092 farm year of observations. Now here there is one part that I would like to mention. Sometimes we think that if the sample is large, then there is more chance of acceptance, which is absolutely not the case. Large sample never guarantees your publication or acceptance of the paper. So whatever be the sample, yes, definitely there has to be a sizable sample, but large sample means always it will be more acceptable. This is not the case. The main focus is whether you are contributing something new to the literature or not. So large sample does not guarantee your publication or acceptance. So this part you please keep this thing in mind. Okay, is the data part. Data source, mostly the corporate governance reports you can get either from annual reports of the companies. Here I have taken from Pravesh. They publish corporate governance report separately. You can take from Bloomberg also, CompuStat also, whatever be your available source. And the accounting variables you can either take from CompuStat or you can take from Pravesh IQ or any other database which is available to you. Okay, so this is the data part that we will talk about, that we have mentioned. Now we will enter into the earnings management part, the methodological part. So far, Please tell me the introduction part that we have discussed about the framework of earnings management and corporate governance and board composition part. If you have any query or any point that you want to add, anyone, please.
Sir, I have a little question.
Yeah, please.
That why have you excluded the financial firms? If you can repeat that point once more, please.
Financial firms, suppose banks. So for banks, first of all, the accounting pattern is different. Suppose whenever you will design the research, will suppose you will be getting total assets by total assets, earnings, revenue, leverage, whatever those things. So those financial parameters, the accounting pattern of non-financial firms and the accounting pattern of financial firms are different, completely different. This is the number one part. Second thing is that in case of earnings, in case of financial firms, this is a highly regulated industry. So highly regulated by the, what do I say, the RBI. So scope of manipulating earnings is very difficult. That's why we cannot say that banks do not manipulate earnings. That we cannot say. But if you want to do for banks, insurance companies, or other financial firms, you have to conduct a separate set of study. We cannot mix financial and non-financial firms because accounting pattern is different. Assets means different, leverage part is different. In case of banks, the deposits which you are taking, that becomes your debt. On the other hand, here objective is different, the asset structure is different. So that is why financial firms have a different accounting structure. So we don't mix financial and non-financial firms. In no study we mix because accounting pattern is different. Okay.
Okay, thank you, sir.
Anything else?
Excuse me, sir, I have a question.
Please.
You are discussing about how to write the introductory part of a research paper. So,
Okay.
sir, if I am writing a descriptive paper, how
Hmm.
can I relate it to a theory? I'm writing a research paper on the emergence of virtual banking in India.
Mhm.
So, to which theory can I relate?
Yes, in this case, try to understand the theories means what I'm trying to say. If you are working on an area on which you have some existing theories, then you must give the reference of those theories, that how this your study is relating to those theories. But if you are writing a theoretical paper, conceptual paper, any paper, I am not completely aware of your area, whatever you are trying to in virtual banking or whatever, but that has definitely, if you find the that has to have some linkage with some existing theories. If not, if you want to propose a new theory that so far, suppose you are working on an area which is completely novel, there is no existing research, suppose for the sake of debate, then also you have to mention that yes, this is the new theoretical framework that I am trying to discuss. See, what I am trying to say is that suppose you are doing, I am taking certain independent variables, certain control variables, maybe one or more dependent variables. I'm running a regression, getting a result, fine. So whatever be the result, ultimately that result should have some policy implications, some theoretical implications. What is that theory? What are you trying to contribute to the literature? That has to be mentioned very clearly. Now, if you have existing theories, then you give the reference. If you do not have any existing theories, then it's not possible for you. If you want to propose something new, that also you have to highlight. That since there is no such theory highlighting on that particular aspect, we are trying to propose and give a name of that theory. Okay, based on your logic, based on your discussion. This is mainly I'm talking about for those aspects, those papers for which existing theories are there. Okay.
Okay.
Yeah,
Thank you,
yeah.
sir.
Reena, Prasad, and Arnab, you have query.
Uh, Good morning, sir. So I've
Good
just
morning.
one query to ask here, that we were talking about earnings management. So I'm just trying to understand one thing, that earnings management is uh, different from fraud or earnings quality, or for that reason impression management, are the same thing, or there is a difference between?
Very, very vital question you have asked. Earnings management doesn't mean, we cannot say it means fraud. We cannot say fraud. Earnings management doesn't mean fraud always. But earnings management means somehow you are hiding the actual scenario, and either you are inflating the earnings or you are reducing the earnings. based on your requirements, based on your objectives. Now, sometimes, most of the cases we have seen that earnings management, sometimes it has a linkage with the fraud. For instance, if you take the Sattam case, in the next part we will discuss Sattam case, when Ramanandam Raju, he reported maybe 6,000, 5,000, 6,000 crores of cash. He means, I'm talking about the company, I'm not mentioning anyone. He was the chairman, that's why I'm mentioning. But actual scenario was only 321 crores or something like this. So that is whether will you call it a fraud or will you call it earnings management. Ultimately, you are reporting something more than what is the actual scenario. That's earnings management. But earnings management, not necessarily these are linked to fraud. But in many cases, this may be linked to fraud also. But if you ask me theoretically, or if you ask me the conceptually, are they same? No, they are not same. Earnings management means maybe sometimes you're smoothing your earnings, sometimes you're inflating your earnings, sometimes you're reducing your earnings, and your underlying objective may not be fraud, but sometimes it may be fraud. So that's the crucial question you have mentioned. Whenever you are writing paper like this, you do not use the term manipulation or fraud. You should not use the term unless you are working on a specific that kind of sample term. You should mention manage earnings, smoothing earnings, adjusting earnings. So fraud and management are not same thing. But sometimes earnings are managed and the hidden objective may be fraud. Okay?
Thank you, sir.
Yeah. Please. Hina or someone else was raising hand. Anyone else? No. So let me go for the next part, that we are discussing. Yeah, the data part. Now regarding the methodology part. Now for accrual based earnings management, mostly we go for there are different types of existing models which have been developed from time to time. Since we are not discussing only about earnings management, I will not discuss too much about the methodology part, but certain aspects I will be talking about. Now, there are different methods which have been developed from time to time for the purpose of earnings management. And the one which is most widely accepted is called the calculation of discretionary accruals, popularly known as DA. Okay, not dearness allowance, it's discretionary accruals. Now, DA is computed by using different methods. The method which was very much popular in the existing studies is called modified Jones model, or we also call it Dichow et al. In 1995. And the recent one, relatively recent one, is Ramon and Sarun model. So there are different models which have been in use for the estimating the discretionary accruals. Now the question is whether you are using modified Jones model or you are using Ramon and Sarun model. It's up to you. Broadly, what I am trying to say is that whenever for any variable calculation, if there are existing methods, and whenever you are selecting the method, you have to understand that which method you want to use and why. So if you are using method 1, not method 2, or you are using method 2, not method 1, so reasons behind that you have to highlight. So what is important is there that you mention why you are planning to use, or why are you using modified Jones model, why not the other models. Similarly, always keep an alternative method if existing. If there is no such method, then you have nothing to do. Suppose you have multiple models, multiple methods. Here, suppose I am using modified Jones model, but you keep another method for the purpose of robustness check, if available. So when you have 2 methods or 3 methods, use the most popular one. Most popular one means the most scientific one, and the one which has been used in existing literature. See, at the preliminary level, if I say even my standard also, I cannot comment whether Ramon and Sarun model is better or modified Jones model is better. But what we can say is that Ramon and Sarun model has been used in the recent literature, and those papers are published in the top rated journals. So whenever you are giving reference that Ramon and Sarun has been used in so and so papers which have been published in so and so journals, automatically that will be accepted. That accepted means yes, your model is accepted. You are using a well accepted model. And always keep another method for the purpose of robustness check. So you are using your basic regression based on one model, and later on you are using another model for the purpose of robustness check. And if you get similar kind of results, then your chance of acceptability will be increased. So robustness check is very important whenever you are doing any empirical paper. It's not valid, not for theoretical papers or conceptual papers, but for any empirical paper, robustness check sometimes becomes very crucial in good quality journals. Now here, in case of, if you talk about this earnings management part, is the modified Jones model part. I am not discussing much about this because in case you are working on earnings management, then only you will go for that. In case you are not working on earnings management, you may not go for this. So the basic model, just for 5-10 minutes, I don't want to discuss basic model which has been given. Simple thing is that we find out something called total accruals, and from there we deduct something called non-discretionary accruals, and the difference is called discretionary accruals. So let's say total accruals is 100, but non-discretionary accruals is 90. So difference 10, this 10 is the discretionary accruals. You have applied your discretion to inflate the earnings or to reduce the earnings. That is called the discretionary accruals part. So this method part I am not going here because you may be interested, you may not be interested on that. So whatever model, maybe you are using some different model also. Francis et al. Model is also there. So based on that, you need to go for this model. Now let me come for the variables that we have tried to understand, developing the research framework. So whenever you are talking about the research framework, you should give a clear measurement of different types of variables. Since we are discussing this topic in the context of a definite research paper, specific research paper, let me explain the variables which we have taken. So for earnings management, initially I have taken this discretionary accruals measured in terms of modified Jones model. Then certain governance variable. What are the governance variables you have taken? One is the board independence, that reflects the percentage of independent directors on board. Then is board business. Board business is a dummy variable, which takes the value of 1. If you have at least one independent director in your board who is holding directorships in 3 or more companies, then 1, otherwise 0. Means some busy people are also sitting in your board as independent directors. Then another variable called board diligence. Board diligence means the mean percentage or average percentage of board meetings attended by the independent directors. Then another is called fourth parameter is CEO duality, whether CEO is the chairman of your board or not, or they are different. CEO duality. Then you take another variable, multiple directorships. Means one director on an average is holding how many directorships of other companies. So average number of directorships held in other companies. So these 5 parameters are your board of governance, or you can say corporate governance parameters, or board quality parameters, whatever you say. Okay. Then if you come for the ownership structure, then for ownership structure we have taken 3 important parameters. One is your promoter share, means percentage of equity shares held by promoters. Second is DII shareholding. DII means domestic institutional investors, means banks, insurance companies, mutual funds, Indian banks, Indian insurance companies, Indian mutual funds. They hold a substantial part in different companies' shares. So DII shareholding. And second is FII shareholding, foreign institutional shareholding. That's the ownership structure. So promoter share, DII share, and FII share, these reflect your ownership structure. And then you talk about the different types of control variables that you are considering for your study. Here, for instance, you have taken firm size, leverage, market to book ratio, that is firm's growth, your cash flow position, cash flow coverage, and firm's profitability in terms of RE. So these are the variables that we have taken into account. Discretionary accrual being the dependent variable, 5 governance variables, 3 ownership pattern variables, and the other variables. Now we'll talk about the models that we need to discuss. Now here, when you go for this kind of study, with the corporate governance, earnings management, or governance parameter and firm performance, generally you will find in most, since it's a panel data, suppose 364 firms for 3 years, either we go for fixed effect or random effect according to the suitability, or sometimes you go for pooled OLS. Now if you go for fixed effect or if you go for pooled OLS, you'll be getting one kind of results, but that result may not be correct. So in this kind of scenario, there is a problem called endogeneity problem. So endogeneity problem is very crucial in this case. So as for methodology, here what we have taken is that I am just explaining. First, I'm using fixed effect model. Second, I'm using pooled OLS model, and I'm seeing what are the results. Then I'm trying to understand whether these results are actually acceptable or not, with the logic, with the methodology. If acceptable, well and good. If not, then what should we use? We should use an alternative method, which is called generalized method of movement, or GMM method, which is more popular, which is more, I should not say popular, which is more justified in the context of endogeneity problem. So let me talk about this part here. So first, you are using the fixed effect panel model. You are giving the regression equation, whatever you are doing, or you are using the pooled effect. I hope you are well acquainted with these basic fundamental models. Pooled OLS model, you are giving the regression, and based on this fixed effect and pooled OLS, you run the regression and see your results. Now, if you see the results I am coming later on. If you see the results, you may find that there can be something called endogeneity problem, which is not properly addressed by pooled OLS or fixed effect model. Now, if you see in this kind of literature, governance variables and firm performance, governance variables and earnings management, this kind of studies, you will find that there can be different types of endogeneity problem. The first one is called this dynamic endogeneity, means when its lagged value influence the variable's current value. So current year, you are managing DA, discretionary earnings. You can say managing earnings. If you manage earnings this year, it will have an impact on the next year. If you manage earnings the next year, it will have an impact in the next to next year. So lagged value will always influence your current value. That's called dynamic endogeneity, which is not properly addressed in fixed effect or pooled OLS method. Now, second is called simultaneity. That means when two co-determined variables influence each other simultaneously at the same time. Or there can be something called unobserved heterogeneity, when a relation between two or more variables is affected by an unobservable factor which we are unable to identify. So in this kind of scenario, be it pooled OLS, be it random effect, be it fixed effect, that doesn't give you the clear picture. In such a scenario, if you want to address the endogeneity problem, system GMM is a better model for the purpose of usage. Now here, generally most of the cases what we do, if you see, with due respect to all the researchers, even I also did the same thing. I published a paper based on just fixed effect model, and that was published in a moderate level journal. But later on, when I use the same model and send to a higher level journal, they completely rejected. They said, why are you using fixed effect model? Because endogeneity problem is not addressed here. So do something new. So then I came across the system GMM. Then you have to improve yourself in the context of methodology. So here, what I'm trying to say is that in the next case, you can use something called system GMM method, where you can take this Arellano and Bauer and Blondin and Bond. The system GMM method, they proposed this method for the purpose of understand this GMM part. So here D means your discretionary accruals, okay, and L dot means you are taking the lag value, okay. Then your vector of governance variables, that vector of earnings management, control variables, and in the second case, first you are taking lag, and then you are taking change. Delta means change of the variables. So both you are taking into account. Now here I am not an expert in the econometrics part. I am not going to discuss this part. Whenever, if you are working in this area, you must go for this Arellano and Bauer model and Blondin and Bond model, popularly known as system GMM model, and you learn all those things. What I'm trying to say is that we need to identify the proper method which is applicable in this case. And let's say I'm a commerce student, I may not have that much expertise to understand this model. I may not have, not necessary. Then you can collaborate your work with someone who knows that model. He or she can be from statistics area, can be from economics area, can be from other areas. So that application of the correct method is very important. And is my personal view, nowadays, at the present level, if you work only on, if you work alone, I mean, suppose you have expertise in finance, you want to write paper, sole authorship. Maybe one or two papers you can do at moderate level journals. But most of the cases, collaborative research is more important, because until and unless we do not invite the expertise of other fields, Suppose you are working in a finance area which needs a lot of analytical tools. So any professor from statistics or analytics can be your co-author, and he or she can help you. You are using more and more econometric methods. So maybe any statistician or any financial economics background, any of your colleagues or faculties, they can contribute in that paper. So collaborative part, I think it's very important. Not necessary that I know every aspect of methodology. That's not possible. So that's where the collaboration part plays an important role, and you are much aware of this part. So system GM part we have tried to use. Now see, in case of system GMM, there are certain methodological aspects that your Arnold bond, they are saying first order residuals correlation need not be zero, but the second order should be zero. These are the methodological part. I am not going in this methodological part. Once you use this model, definitely we'll be using those filtering parts and all. Now, the results and discussion part, let me give you some brief aspects here. I am not I won't discuss much about the findings part, because not necessarily you'll be working on that data, you'll be working on some other data also. But to briefly show, if you see that in the top 500 Indian companies, about 50% of the board is independent, 51% of the board is independent. About 88% in about 88% companies, you will find at least one independent director who is busy. Busy means who is sitting on 3 or more other boards as director. Board diligence, if you see, almost 80%, 79.71, 80% of the board meetings, they are attended by the directors. CEO duality part is very crucial. Only 0.004 means 0.04%, if you take in terms of percentage. In very few boards we have the CEO duality, because same person is enjoying the power of CEO as well as chairman. Promoter shares is 55%, quite natural. It's the case of all the emerging economies that promoter shareholding is the most majority, because family-owned businesses are more. Be it Reliance, be it Birla, be it Adani, be it Goenka, be it whatever, Bajaj in our country, family-controlled business is more, so promoter share is definitely more. If even in government-owned companies, also government being the promoter holds the maximum share. Multiple directorships you will find on an average 4.965 means on an average one director is holding the directorships in 5 or more companies. Then you have about, if you see, 9% is the DII share, about 11% is the FII share, and the remaining variables. Now here I'll talk about the findings which we are getting in this context. Now see, initially, as I said, first I am running a pooled regression, model 1. Then in model 2, I am running a fixed effect model, fixed effect regression. I see the findings. If you see, interestingly, if you take board independence under pooled OLS, it's significant. Negatively, be it negative, positive, significant, how it's affecting earnings management, that's a different issue. But look at the significance part. Board independence is significant. Board diligence is significant. Promoter share is significant. CEO duality is significant. So 4 governance variables are significantly affecting earnings management. So initially I was excited. Fantastic result. If you see the fixed effect model, then also you will find that all the 4 variables, board independence, five governance variables are having significance. Now, first question comes, are these results reliable? Based on these results, if you draw any conclusion, that will not be valid, because these are actually overestimating the relationship. These are not actually addressing the endogeneity problem. So in the next case, when you use system GMM, in case of system GMM, what kind of results you are getting? Let's see. In case of system GMM, you are getting lagged DA, means previous year's discretionary accrual is having an impact on the current year's DA. That is significant. Board business independence, not significant. Board business, not significant. Board diligence, not significant. only promoter shareholding and CEO duality are significant. Means companies where promoter shareholding is more, they tend to manage more earnings. Similarly, companies where same person is enjoying the benefit of power of CEO and chairperson, the earnings management is more in those kind of companies. So only two variables, promoter share and CEO duality, these two variables have significant impact on the earnings management. Remaining governance variables do not impact the earnings management. That's why what I'm trying to say is that if you recommend a policy implication, then based on the previous results, then your policy implications will not be proper. Means you can say, okay, if the board independence is more, then earnings management will come down. If so, you try to make more and more board independence. Whatever you have existing norms as per SEBI, 50% of the board should be independent or 1/3 of the board should be independent. You are trying to increase that position. That will not going to help the reducing the earnings management or curbing earnings management. So whenever you are recommending the results, you should consider based on the actual based on the appropriate methodology. So here you find that only promoter shareholdings and CEO duality. So one part of the ownership structure and mostly the control part, they actually manage the earnings, which is quite obvious. Because if you see in real life scenario, if you sitting on the boards, if the CEO is also enjoying the power of a chairperson, then who will ask the tough question to the CEO? Mostly he can manage the board very nicely and run the functions smoothly as per the objectives of the company. Okay, so these are the things that you need to keep in mind while suggesting the results. Now, one more thing I'd like to mention, if you see the last in this case. Okay, so far, just a minute. So far, first, if you see nicely, I'll take your questions. If you see minutely, Model 1 talked about pooled OLS. Model 2 talked about fixed effect. Model 3 talked about your system GMM. But here we have not taken the institutional investors variable. Means DII, FII we have not taken. So next model 4, 5, 6 we have taken DII, FII also. Okay. So if existing variables are already there. Plus we are taking DII share as well as FII share, the institutional investors perspective. And here more or less what kind of results we are getting. So model 4, 5, 6 all are based on system GMM. What is the difference? Difference is that model 4 we are taking DII, model 5 we are taking FII, model 6 we are taking both DII as well as FII. Okay, so in this way I have tried to segregate the models so that it's easily understandable. And here what kind of results we are getting? See, lag DI is significant, promoter share is significant, CEO duality is significant. What about this second case? Lag DI is significant, promoter share is significant, CEO duality is significant. Model 6, lag DI is significant, promoter share is significant, CEO duality is significant. So similar type of results you are getting in all the cases. When you take DII separately, we find significant here. When you take FII separately, we don't find significant. But when you take both DII and FII, then you are find FII is significant. So here, these are the results. And you can always interpret the results, why DII is significant, why not FII. One logic is very clear that we understand that if you are an Indian bank, Indian mutual fund, or let's say Indian insurance company, and you are holding significant portion of share of a company, you have a lot of voice to say about the functioning of the company, about the governance of the company. But if you are from abroad, FII investors, that much control is not there. For instance, if you see 2019, if I am not mistaken, 2017, when Infosys was facing severe governance problems. So all the mutual fund companies, Indian mutual fund companies, the association, they wrote a letter to Mr. Narayan Murthy on that point of time. Then the CEO was changed also, that what is going on about the governance, we would like to hear from you. So please discuss and try to and let us give us the brief about what kind of governance problem the company is facing. So this direct intervention is more and more possible, more and more feasible for domestic institutional investors. For FIIs, that intervention part is relatively difficult, because if you are LIC is holding the shares of different large Indian companies. So LIC has a big role to play there. But if you are an FII, that role, that FII institution may not be able to play on an Indian company. So that can be the possible logic in case of DII be significant, FII not. Okay. So you are getting, so this whole study, I have tried to divide in 6 different models. Once again, I am saying, model 1 is talking about pooled, model 2, pooled OLS, model 2 fixed element. Then you are criticizing because all these variables are significant because we are not addressing the endogeneity problem. So same variables, if you apply system GMM, we are getting different results. And we are seeing we have established methodologically that GMM is a better method than fixed effect or pool OLS. For remaining models 4, 5, and 6, we are using only system GMM. Model 4 with DII, model 5 with FII, model 6 with both DII as well as FII, plus other parameters. Now you can stop here up to a certain level, but always it will be better that the results which you are giving based on system GMM, how do I believe that these results are actually appropriate? So can you show an alternative model, system GMM, and also you have used the modified Jones model. So whenever you are using any model for the purpose of justifying your dependent variable, if you have alternative model, if you don't have, we cannot help it. If you have alternative model, you must use that alternative model for the purpose of robustness check. So here, for robustness check, I have used another model, that is Francis et al. Not necessary that you have to use Francis et al. You can use Raman and Saru also. Okay, so in Francis et al., whenever you are using and see the results are similar or not. If you see lag DA significant, promoter shareholding significant, CO duality significant. It has 2 different parts, absolute DA and DA quality. Here also you are getting lag DA is significant, promoter shareholding is significant, CO duality is significant. So through robustness check, you can, if you can establish that yes, your findings are holding good even under alternative methods, then the chances of acceptance will be higher. Your paper will carry more weightage in this case. Okay, more weightage in this case. Now I'll come for the some policy implications. Before that, I stop here. If you have any query, please. I'm waiting for your questions, please.
So participants, at this juncture, if you have any query for Professor Chatterjee.
Any query? No? Okay, fine.
I guess you can proceed. Yeah, Chanchal, you can proceed.
So the next part, when you have already talked about the methodology part and the findings, the next, when you come for the major findings and the conclusions, okay. So here, one thing that I would like to mention here, that while you are reflecting your findings, fine, try to understand one aspect, that your findings should have a linkage with the policy implications. Policy implications. So what kind of policy implications you are giving, that's a very crucial aspect. Here, let me give you certain aspects based on the findings of this paper. Suppose in conclusion part, whenever you are writing that these are my findings or these are our findings, always you try to link with some established existing papers findings. Means whether your findings are different from the findings of the existing papers, or existing some selected existing papers, or your findings are in line with their findings. That will always help you to establish that yes, you are getting a different result, and if you are getting a different result, reasons behind that. If you are getting similar results, then fine. Now also, apart from your findings, the findings which you have got, if you are working in those kind of things, the governance variables, etc., how are they linked with the policy implications? For instance, if you see here, we have found that mostly two variables are significant as far as governance variables are concerned. One is its promoter shareholding, second is CEO duality. So whether promoter shareholding, if promoter shareholding is more, the chances of earnings management is also more. So your policy implication can be that companies should, or in the SEBI, the government should think of reducing the promoter shareholding and increasing the public shareholding. That can be your recommendation to the policymakers. That SEBI should essentially think about reducing the earnings, reducing the, reducing the promoter shareholding, and they try to increase the public shareholding. If you see in this context, in 2019, government has already taken the steps that for certain companies, promoter shareholding should be reduced to a certain extent. I don't exactly remember the percentage. It's mentioned in the paper, and the government has taken the initiative, SEBI, that you should reduce your promoter shareholding by that deadline and try to increase your public shareholding. For one of the instance, if you see this, Mr. What's that, Bandhan Bank CEO, Chandrasekhar, Mr. Chandrasekhar. Okay, Chandrasekhar was asked to reduce his
Chandrasekhar Ghosh.
Chandrasekhar Ghosh to reduce the promoter shareholding in Bandhan Bank and increasing the public shareholding part. That's a different part in banking sector. That policy already government has implemented. So if you are recommending something which as government is already recommended, okay, before your publication, before your submission of the paper, then you should think something different. If that is not yet recommended, then you can say that the government can think on that line. Similarly, look at the CEO duality part. It's very interesting part. CEO duality in the Indian context, the real governance parameters, if you see, those who are already working in the field of corporate governance or you have a plan to work in that field, we have the concept of independent directors, non-independent directors, executive directors, non-executive directors, etc., etc. But ultimately, the chairman of the board is the boss. And in most of the cases, if you see the CEO himself or herself being the chairman, then it's very difficult to question the chairman of the board, because CEO often handpick the board of directors. That's the scenario not only in India, throughout the world. Okay, so whatever norms we have, be it independent directors, be it other directors, mostly independent directors or directors rather, those are handpicked by the CEOs in most of the cases. Now, CEO duality, as per our findings, what we can say, companies where CEO and chairperson is the same person, earnings management is more. Whereas if there is separation between CEO and chairperson, earnings management is less. Now, if you see, now you try to link with the Uday Kota Committee 2017. Uday Kota Committee clearly mentioned that by 2020, 1st April 2020, top 500 firms in terms of market cap, they have to split the position between CEO and the chairperson. Okay, and there was debate whether it's a justified opinion or not justified opinion, but whatsoever, SEBI has accepted this proposal and SEBI has issued the guidelines that you have to split the position of CEO and chairman for top 500 companies in terms of market cap by April 2020. But interestingly or surprisingly, this has not yet been implemented, gradually delayed. So recent deadline is April 1st, 2022. So 3 more months. Okay, so by April 22, all top 500 Indian companies, they have to split the position between CEO and the chairperson. So whatever you are finding, your findings are actually supporting the recommendations of Uday Kota Committee. So you can always link that these are the policy implications which we think should be implemented, and the Uday Kota Committee has also implemented or also suggested this. So that can justify your policy recommendations, and better level of justification if you give in terms of policy implications, the chances of acceptance will be more. Okay. Now here the last point that I would like to mention here, existing framework, existing studies are always there. You can always use their references, but always, if possible, try to introduce some new variable in your study. If you can introduce some new variable which is very significant, then the chances of acceptance will be more. For instance, I am talking about in this case, suppose you are talking about new board governance variables. The governance variables which I have taken, nothing is new except one, that is the board diligence part. Board diligence has been used in very 2 or 3 papers, mostly Sarkar et al. Sarkar et al, they used that board diligence part. Otherwise, most of the case papers, they have used the average number of board meetings held. Board meetings held and board meetings attended are different things. So board meetings attended is reflected by board diligence. Now suppose you want to introduce a new variable. I am just thinking on that line. You can always think a better variable also. Suppose, is there any let's say external agency to evaluate the board of directors? If you see the corporate governance reports, Infosys has this. If you read the corporate governance report of Infosys, if you read the corporate governance report of L&T, you'll find that they have an external agency which will evaluate each and every board member's contribution in the board. So if any external agency is evaluating the board members, then there is an indirect pressure from the management that as a director, you have to perform better. Perform in the sense your contribution in the board for policy making and all these things. When this external agency is there, that is that we can say the company is more serious about the role of the directors. And when external agency is not there, company may not be that much serious about the role of the directors. So if you can take this kind of variables, that way maybe a dummy variable, that whether you have external agency to evaluate board of directors, 1 or 0 otherwise, then it's a new variable you can always introduce here. Second, you can always think why I'm referring to Infosys and L&T, because L&T and Infosys are considered to be very good as far as their corporate governance structure is concerned. If you, especially L&T, Infosys also, if you see their corporate governance structure, the type of disclosures, how they disclose, how they form different committees, and different types of evaluations which Ministry of Corporate Affairs makes from time to time. They are top-rated companies in terms of governance structure. That's why I'm just referring to. There are many more companies which have this kind of framework, and there are several companies which do not have this framework. So this is one new variable you can include. If you can include this kind of variable, the chances of acceptability will be significantly higher. Similarly, is there any peer review system within the directors? Means one director A is evaluating director B, director B is evaluating director C, C is evaluating D. So if there is any cross review part, that's very important aspect in this case. I mean, new variable. Third variable, you can see the cross holding. Cross holding means within your sample, maybe Mr. A, suppose 364 firms you have taken. Mr. A is the director in 5 of those firms. Mr. B is director in 4 of other firms or 6 of remaining firms. So there can be cross-holding. A is sitting in B's board, B is sitting in C's board, C is sitting in A's board. So cross-holding part is there. If there is cross-holding part is there, it's very difficult to identify. It's very difficult to extract those kind of variables unless you have proper database. Unless you have proper database of independent directors or directors database, it's very difficult. There is a database called Prime database. In case you are working, Prime database is giving you all this information that who is sitting in what are the company's board and the cross-holding, cross-chain part. If you can capture those kind of variables, then it will always help you to justify that we are including some new variables, and that new variable will enhance the, give you a better picture about the governance structure and earnings management, or governance structure and the other maybe financial performance or whatever. So that will help you to understand, to show you your contribution properly. So these are some of the aspects which I thought should be maybe important for understanding, and we can always keep on discussing this part about governance and earnings management. So not necessary that you'll be working exactly in this framework, but these are some of the parameters, some of the fundamental aspects which help us in respect of taking the decisions. And the paper which I have just discussed is in the context of this one: ownership pattern, board composition and earnings management evidence from top Indian companies, International Journal of Disclosure and Governance. It's published by Springer. In case you are interested, I will be forwarding this journal to Professor Abhik Mukherjee. He can always circulate to you. So these are certain things which I thought I should discuss. If you have any query, based on this discussion, please.
Professor, good morning. I am Sasi Kumar,
Good
Professor
morning.
Chanchal. Very good morning.
Good morning.
Yeah. Now, my question is about one is about methods that are used by the researchers. In some of the papers, I observed about one direction of papers in the literature. They are concentrating more on panel data.
Hmm.
Due to panel data limitation, some of the papers reviewers they are writing about use about dynamic panels, and they are asking to justify why you're using dynamic panel data.
Hmm.
And in some of the researchers on board performance, like international papers, simply with the panel data,
Hmm.
they are trying to prove, as you said, the new variable have a significant effect on board performance or corporate governance structures,
Hmm.
because it was specially observed by me in case of role of female directors in the decision making process.
Hmm.
So what's your take on this? Because when future researchers work trying to work in this area, how they should identify about it? Because in econometrics or maybe any other statistical method we use, definitely it will have its own limitations, it will have its
Hmm.
own mm, things need to consider about it.
So,
So could you throw some light on this area, so
fine.
whoever trying to work about it? Because one thing is very sure, we are all from different places. As you rightly pointed out, the database availability, either it is a CMIE database or a prime database or something, which we have a limitation in that area also. So because when I worked on one paper, I try to collect from different areas like money control and other places, but it is not sufficient, as you rightly pointed out. So how to face, even this is the second area.
See,
Thank you, Professor.
in this very good question you have asked, let me give you a very brief response to that. See, thing is that whenever any paper is coming to me or anyone, a reviewer, the first thing the reviewer sees that is there any novelty in that approach? Is there something new? Now, generally, sometimes we may have the idea that if you take 100 companies 5 years vis-a-vis 1,000 companies 5 years, the second one is better. Larger the sample, better will be the results, and better will be the higher will be the chances of acceptance. This is not the case. Or if we use more and more complex methods, more and more mathematical abbreviations, that will enhance the chance of acceptance, which is absolutely possibly not correct. What I'm trying to say is that whenever you are trying to publish any paper, be it role of women directors in corporate performance or any other aspects, the first and foremost thing is, are you contributing something new in the literature? That contribution may be from your theoretical development, you are giving a new theoretical development, or the contribution may be you are introducing some new variables which have not been captured so far. There are papers with just for one variable published in a star journal, one new unique variable published in a star journal, you'll be getting this. So what I'm trying to say is that if there is something new, that new variable or new idea, new method maybe also, you can always focus on that. As far as the methodology part is concerned, if you take my view, I am not sure whether it's recorded or not. It's recorded, I can see, but my view is that don't focus too much on methodology part, but yes, you should know what is the appropriate methodology. For instance, in this kind of study, if you just use the simple panel data method, then if it's a good journal, they will simply ask the question that how did you address the indigeneity problem, and you will have no answer to this. So you should at least know that yes, in this kind of relationship empirical paper, indigeneity may be a problem where GMM is a better method. So you just simple use GMM, no such problem. Or in earnings management, either you use Raman and Sarun, or you use modified Jones model. Use one main model and use the second one as robustness check. Fine. So don't give much importance on the methodology part. Only you should know what is the appropriate methodology. What is most important is that how you designing the paper, how are you writing, and that part is very crucial. And while writing, if you can innovate something, if you can contribute something new, only one question: is there any new contribution? If the answer is yes, chances of acceptance will be high. If the answer is no, then obviously whatever be your methodology, whatever be your other aspects, the question will be that repetitive, no new contribution to the literature. So new variable, if it is a new methodology, then obviously important. So uniqueness, that's very important. And second, as far as database part you are concerned, yes, we have the limitations. If you have Bloomberg, you have almost everything in your hand. If you have CompuStat and Bloomberg, then almost everything in your hand. But we have the limitations. Since we have the limitations in database, we have no other alternative than to collaborate with others. For instance, I want to work on a particular paper for which I need CompuStat database, but I have no choice. In my institute, I don't have CompuStat. I have Bloomberg, fine, but I don't have CompuStat. So if I want to work on the database, I have to collaborate with someone who is having this access to that database. So that's why I am saying collaboration is very crucial. So if you want to work independently, you can work up to a certain extent, not beyond that. So your collaboration is required from multiple angles. One is access to database. Second is access to methodology. Suppose you are using some new analytical tools. So if you want to learn it and you want to reproduce it, it will take huge time. So why don't you collaborate with someone, some statistician or some econometrician who can easily do that, and he or she can be your co-author. So always keep this thing in mind, that collaboration from source of data, collaboration from methodology part will be the only solution as far as I understand. Okay, as far as I understand.
Thank you, Professor. Thank you for guidance. Definitely I'll follow. Thank you.
Anyone, welcome. Anyone else? Any other query? No more query? Okay. Maybe chat box, there are some questions. Let me, just a minute. Proposed increase. Yeah. Union budget, Dr. Amit Majumdar mentioned that Union budget 2019 proposed increase public shareholding from 25 to 35%. Yes, you are correct. Gender diversity in boardroom. What's your take on gender diversity in boardroom? See, regarding gender diversity, as far as I know, I have not worked much on that area. All listed Indian companies should have one woman director in the board. That is the norms. That is the norm we have right now. Now, whether gender diversity actually helps in improving the board culture, corporate performance, or whatever, then that depends on certain database. We have to work on that. I haven't yet worked, but to my mind, gender diversity in one hand is good. On the other hand, if you see without data, I am just conceptual. I am saying that if you make mandatory that you have to take one woman director, it has a good side, gender diversity. On the other hand, it has a bad side also. So sometimes some well-deserving people may not be admitted to the board, but not so deserving women may be admitted to the board. So that's the crucial part. And in case of women diversity, those who are deserving women, gender diversity, those who are deserving women, they should always join the board. There is no problem in that. But if you see, most interestingly, what happens in the Indian context, I know many of them, I know personally some of them. What I've seen that, suppose company X, although I know the names of the companies, I don't want to mention. Company X want a women director. So they know someone, Mrs. X, Mrs. Y, whatever, or any woman who has some requisite qualification. She can join as a women director. And not necessarily that she will contribute in the board significantly. So this, how are you selecting the women directors? That plays a crucial role. But yes, conceptually we can always argue that gender diversity is important. But just for the sake of gender diversity, if a woman is sitting in the board, everything will be good. That may not be the correct. If the correct person is sitting on the board, be it men or women, then possibly that will be helpful. But the selection of women directors, there are many women directors, men directors also, not I am saying only women. The selection of, what do I say, the independent directors is just handpicked throughout the world without any exception. Be it not only India, without any exception, handpicked. So nowadays, the Ministry of Corporate Affairs, through IICA, Indian Ministry of Corporate Affairs, they have introduced one exam. You have to pass that exam. You have to do so and so things. But those are not very big things. But yes, it all depends on the intention of the company. What kind of people they want to promote? what kind of people they want to be on their board. That's the crucial part. But as far as the real life data and working part is concerned, I have not worked. I will not mention. Yeah, please.
Professor, may I ask you a small question?
Yeah,
Maybe it's
sure.
only a wild thought. Probably, if I'm wrong, please try to correct it. In the
Please.
papers, one of my observation was there are maybe I didn't identify it. Can we consider the impact of profile of the directors on the earnings? Directors' profiles, like maybe their background, experience, their qualifications.
Mhm. Yes, definitely. That's another aspect, that the quality of the directors and their impact on so and so. So, but
Yeah.
identification of the profile of the director is a big challenge. Big challenge in the sense, for instance, suppose if you see an artist or a journalist is the director. Journalist is the director. It was Dinesh Dubey. Whether you heard the name or not, I don't know.
Yeah.
Dinesh Dubey was the independent director of Allahabad Bank, and there was severe problem. It's public information, so even if it's recorded, I am not worried. He was the first person who opposed sincerely to sanction loan to Gitanjali Jains, Mehul Choksi case. Okay,
Yeah. Yes, sir. Yeah.
but he was a journalist.
Yes.
But he only gave an interview in the public, that in the public domain, that later on he was pressurized by the Ministry of Finance and he was forced to resign. So a journalist, generally we can say, let's say only graduate, he or she may not have
Yeah.
that much
Mm.
expertise, but sometimes they may have the expertise. So it's very difficult to capture the profile. If you see, qualification is one aspect, then the apart from the qualification, what do I say? The
Yeah.
profile, the domain expertise is another
Domain
important thing.
expert.
For example, I don't understand anything about IT. So if I have some understanding about the finance, so if I'm sitting on the companies in Infosys or TCS boards, so on IT related matters, I'll not be able to do justice. On financial matters, maybe I'll be able to do justice. So profile of the director and linking to the nature of the business. It's the points which you have mentioned is definitely important, but speaking something on that, or and you are converting into a research paper, then identification is a crucial challenge. It's not impossible. If you can identify those variables one by one, then that will be fantastic. Definitely, you are correct. I must appreciate your thought. That's important.
Thank you, Professor. Thank
Okay.
you.
So welcome. Kindly share the research paper. Yeah, I'll forward to Professor Mukherjee. Abhi Mukherjee, he will share to all of you. Okay.
Yeah.
So we have
So
come to the end of
so
the
exactly, you have entered. The train has entered the station right at the nick of time. So thank you, Dr. Chatterjee. We have come to the end of this engrossing discussion, and it was really interesting. I was totally uh, uh, continuously looking at the presentation as well as the details which you have made. And I'm sure that your expertise in research writing and research domain will add a lot of knowledge to the participants of this FDP. So thank you very much. So participants, over here, we take a short coffee break. Let Dr. Chatterjee take some rest and a short break, and we will start the second session after 15 minutes. And the login time will be from 11:40 onwards. So thank you, Chatterjee. We catch
Thank
up.
you. Okay, sure. Thank you all.